Imagine staring at a screen, just waiting for a highly anticipated U.S. jobs report.
Oh, yeah. It can be super tense.
Yeah, and the absolute second that data hits the wire, the numbers flash, and currencies like the euro and the Japanese yen, they just instantly, violently reprice.
It is wild to watch.
It really is. You're basically watching the invisible forces of global money flow in real time. So today we have this article for our deep dive that looks under the hood of those moves, focusing specifically on the heavyweight division of global finance, which is the Forex majors.
Right, the really big ones.
Yeah. Okay, let's unpack this because there's a specific reason they all react so heavily to U.S. data, right?
Oh, yeah. The U.S. dollar is the undisputed anchor in this heavyweight division.
Yeah.
I mean, it sits at the absolute center of international trade and, finance and global reserve holdings.
Right.
So because of that intense gravity, the dollar makes up 1/2 of all 7 major pairs.
Which is, reading these pairs used to trip me up a bit, but our source lays out this brilliant seesaw analogy. So you have the base currency first, and then you have the, quote, currency.
Yeah, exactly.
So, take EURUSD. If the euro, which is the base currency, if it gains weight from a strong European economy, the chart goes up. But if the dollar, the, quote, currency on the other side, gets heavier, well, the chart goes down.
Right. The order dictates everything you see on the screen. And since the U.S. dollar sits on one side of every single one of these 7 seesaws, you might expect them to, I don't know, move in perfect lockstep.
Right, like they'd all just do the exact same thing.
Exactly. But the charts actually look completely different.
Because the other side of that seesaw has its own massive economic engine, right? Each partner currency has a really distinct personality.
They really do.
Like, take the British pound against the dollar, GBPUSD, which our source notes is often called cable by traders.
Yeah, and that's a great piece of financial trivia, actually. It got that nickname in the 1800s because exchange rates between London and New York were transmitted across the Atlantic via this giant telegraph cable on the ocean floor.
Oh, wow. That's actually really cool.
Yeah, and today, cable reacts aggressively to domestic policy, like UK inflation data and wage numbers.
Right. While other pairs play a totally different role. I mean, the Japanese yen and the Swiss franc, so USD-JPY and USD-CHF, they're described as defensive risk-off havens. But, I mean, why do traders flock there when things go bad?
Well, it really comes down to structural economics. So Japan and Switzerland have massive overseas investments.
Okay.
And when global markets panic, institutions in those countries pull their money out of risky foreign assets and basically bring it back home.
Oh, I see. So that sudden repatriation creates massive demand for the yen and franc.
Exactly. It drives their value up,
Right.
even if there is literally no domestic news in Tokyo or Zurich.
Wow. And then you contrast that with the commodity currencies, right? Like the Aussie and the Kiwi, AUUSD and NZDUSD.
Right.
The source highlights that the Aussie hinges heavily on Chinese economic indicators, which makes perfect sense when you realize Australia is this massive exporter of raw materials.
Yeah, like iron ore and coal.
Exactly. So if Chinese manufacturing slows down, they buy less Australian metal, and the Aussie dollar drops as a direct result.
Yeah, you are essentially seeing the physical supply chain dictate the currency chart in real time.
Wait, so following that logic with the Aussie, I mean, Canada is a massive energy exporter, so if I see crude oil prices spiking on the news, I can just assume the Canadian dollar is surging and blindly short USD CAD, right?
Well, what's fascinating here is that the market is rarely that simple. A rise in crude oil doesn't guarantee a drop in USD CAD.
Really? Why don't...
Because broader U.S. dollar strength or a sudden shift in, say, Federal Reserve interest rates,
Yeah.
that can completely overpower the influence of oil. You have to weigh the entire macroeconomic picture.
Right, not just one single input, no matter how logical it seems.
You see?
So with all these overlapping complex factors, I mean, oil in Canada, wages in the UK, manufacturing in China, why do traders flock to these 7 specific pairs? Is it just because having so much available data makes them feel safer?
Yeah, and that is a trap many fall into. People hear the word majors and instantly think low risk.
Right, because they're the heavily traded ones.
Exactly. The majors do offer deep liquidity and abundant data. But because everyone, from retail traders to massive central banks, is watching the exact same data, any surprise causes a violent, rapid repricing.
Oh, wow.
Yeah, if everyone expects one number on a jobs report and gets another, the stampede for the exit happens all at once.
A stampede you might accidentally find yourself caught in.
Oh, definitely. If we connect this to the bigger picture, the sheer gravity of the dollar creates this hidden danger of accidental exposure.
How so?
Well, let's say you buy EURUSD, GBPUSD, and AUD all at the same time, right?
Yeah.
Thinking you're diversifying your portfolio across different regions.
Right, because you're in Europe, the UK, and Australia.
Right, but what you've actually done is created a massive, highly concentrated bet against the US dollar.
Oh, because the dollar's on the other side of all of those trades.
Exactly. If a major US news event drops, all those trades could move against you simultaneously.
Man. So whether our listeners are actively looking at charts or just trying to understand the evening news, grasping these pairs is kind of like having a cheat sheet for decoding global economic health.
It really is.
You watch the yen to gauge market fear, the Aussie to track industrial growth, and the euro for interest rate shifts.
It is essentially the dashboard for the global economy. Navigating it requires understanding the unique catalysts behind each specific currency and respecting the sheer weight of the dollar, and remembering that market liquidity does not always equal safety.
Right. So what does this all mean for the future? Because there's a detail in our sources that points to a really interesting shift. The text briefly mentions minor pairs like URJPY or URGBP that completely bypass the US dollar.
Right, they don't have it at all.
Yeah, the dollar isn't on the seesaw for those. So how does that play out?
Well, we opened by talking about how a single U.S. jobs report can send shockwaves through the majors because of the dollar's gravity, right?
Yeah.
But if the global economy slowly shifts away from dollar dominance in the coming decades, you really have to wonder, will today's minors inevitably become tomorrow's majors?
That is a really fascinating thought to leave on.